Welcome back, dividend growth and value investors. Well, I can tell you, your wish is my command. Yesterday, I put a vote out on Twitter which stock you would love me to do an analysis about, and this time you voted for ASML. BASF as a close second, so I will take that one on in the next weekend. But let's get started with ASML. What I will show you in this video are 5 reasons why I am considering buying an initial position in ASML. I will do this by looking into their business, into their growth prospects for the upcoming years, into the dividend safety, also the stock valuation, and last but not least, the prospects of 10 years potential dividend growth ahead for us as dividend growth investors. But having said that, let's start with some chart porn. I really love these kinds of visuals. Look at that. Back in 2009, the company was only paying 20 euro cents in dividend, all the way to €5.50 last year, in which they increased their dividend by 100% after a stellar earnings year. This gives it a 31.8% compounded annual growth rate over the last 12 years in dividends. This is really astonishing, amazing, and I have hardly ever seen this in the dividend growth universe. And don't get distracted by the dividend cut in 2007, because the company, as how it was looking back then, is definitely not the same anymore. So we should really ignore that period from before 2008-2007 when we are looking at ASML today. And if you like this kind of chart porn, then really just subscribe to me, to this channel, follow me on Twitter. You will see more of these dividend growth charts popping up from time to time. But having said that, let's get started by looking into their business, and I believe it's an excellent business. If you don't know ASML yet, it was founded in 1984 in a joint venture or combination between Philips and ASM International, another semiconductor stock. However, it was not operating long in that mode, because in 1988, I believe, it became public, or at least started running on its own. But fast forward to today, more than 30,000 employees and operating in more than 60 locations. So what is ASML really known for? It's their complex lithography systems. I hope I pronounce it well. These are complex machines. Sometimes they need to operate on 3 floors on top of each other, and there are several square meters. It's amazing. I will put a video link in the description of this video, which shows you a journalist that is going into an Intel manufacturing plant, where he shows you one of the ASML newest EUV machines. But if you are new to the semiconductor industry, like myself, because I'm by no means a specialist in this industry, I found this picture from the Investor Day last September from ASML really telling. And here you see ASML as one of the manufacturers of machines that allow you to produce chips and semiconductors. As you can see, one of the biggest manufacturers are TSMC, Samsung, and Intel, and Texas Instruments. And these are exactly the companies that ASML is selling to. And what is so nice about it is that these companies enable again companies like Apple, Microsoft, Alphabet to provide the services today to us as consumers, which I think many of us love. Maybe not Facebook, it's always a bit controversial, although I have nothing against the stock myself. But it was not an easy path for ASML to get here, because what is probably really important to know, that back in 2008 that I just pointed to, that Intel, TSMC and Samsung actually invested heavily in ASML to really start building, designing and selling their EUV technology to them. I would even argue that without those 3 companies, and specifically Intel, ASML wouldn't have existed today as how it looks like. So for me, it's then also really nice that Intel is now having some problems, and maybe ASML is able to help them in the upcoming few years. Full disclosure, I own shares in Intel, nowadays already quite significantly. But that was in 2008. Just look at some of the headlines that we're looking now at when we look at the chip industry. TSMC investing 100 billion in the upcoming next 3 years, and we just saw it's one of the main manufacturers of chips. But also President Joe Biden introducing the CHIPS Act, another 52 billion in subsidies going into the United States, specifically, for instance, towards Intel, who's planning to build a new 20 billion plant in Ohio. But not only there, also 80 billion investment is upcoming in Europe from Intel. So these are really amazing numbers. And also just on the other side of the world, China, another, 80 billion coming up. And guess what? They need machines. And for instance, ASML has a monopoly at the moment when it comes to EUV machines. So just expect in the upcoming years, because this is not a 1 year investment, these are like multi-year investments, expect a lot of orders coming in towards ASML to make this happen, as long as they don't lose their lead when it comes to innovation and technology. But these investments, they don't come falling out of the sky. If you just go to, for instance, the annual report, and I really love the annual report from ASML, and I will also put the link to it in the description of this video, because if you are considering an investment here, please spend half an hour time to read the first 20 pages. It will explain you so much, because the company in their annual report, they explain exactly actually what it is that they produce. What is their technology? Why is their technology special? It was for me a masterclass just in the first 10 pages, just to learn enough to understand why ASML is so special as a company. But what I really wanted to highlight here is that the growth is really accelerated by what they call digital translation. So trends like Internet of Things, everything nowadays need a chip, whether it's the camera in your building, the 5G antenna nearby your house, but also artificial intelligence, right? That really requires high performance clusters and high performance computing. But what about the metaverse? And then think about virtual reality. All these HoloLenses on your head, they all need chips. And they need chips fast. They need real fast chips and really high performance chips. And EUV machines are really helping the industry to build these kinds of devices. So there are really a lot of secular growth trends, and I can't even stop mentioning it, but you will probably see it yourself as well if you just look around you. Digital is everywhere. And ASML is one of the only companies in the world that is able to produce and manufacture the machines that allow their manufacturers to build chips. But what is so important about this strategy, and why I fully understand why strengthened customer trust is on number one? Because this is also where it comes to customer trust, because these customers need to be really able to trust on the machines that ASML is providing, but also that they are indeed having a higher throughput, limited defect or limited outtime, and also at a lower cost. And cost can be, for instance, energy. So I fully understand this, and you really need to think about it like that when you think about these machines that ASML is producing and the value proposition to their customers like Intel and TSMC. So what they also then want to do, of course, is continue to invest in lithography, because that's really where they are having a monopoly now. And one of the things that you need to be aware of, EUV 0.33 is their main machine, and I believe they cost like 150 million per piece that they are producing now. But they already started development of the EUV 0.55, and I'm really, again, not a specialist in this, but they are looking at starting to manufacture those from 2025 onwards and already delivered to their first customers. And at the same time, they want to keep the leading position that they have in DUV, because here they have, for instance, competition from companies like Lam Research, which I believe is also a dividend aristocrat from the United States. So I touched a little bit already on it, but how do they earn their money then? So first of all, they design and build machines, so deep ultraviolet and extreme ultraviolet. But what I also found interesting besides that is that they're also refurbishing and upgrading all the machines. So, you shouldn't look at this as a single one-off version of a technology that they are selling. They learn over the years, and based on that, they improve their products. And you don't necessarily need to replace the whole machine and do a 150 million investment to already get a better throughput. Remember about trust, gaining customer trust. So when they make, for instance, energy efficiency gains in their existing product line, they can offer this to upgrade again and refurbish some of it, so that these older machines still get a maximum amount of time spent out of their life. But hey, sometimes the customer, the manufacturer, just doesn't need it anymore. And in that case, they are also reselling some of those machines to other companies that they know have a need for the older machines, which I think is a brilliant business. So it's not just selling, there's also the whole after sales and making sure to redistribute all the older equipment again to new customers, and again taking a share of the pie from that. I love it really. And what you need to know, ASML is really a monopolist on EUV technology. So this is just awesome when you think about this company as a business model. But this monopoly doesn't say actually that this is the only thing they sell or that's their fastest selling equipment, because actually the DUV machines are growing quicker in sales currently than the EUV. So this is important to understand, I believe, because in the news you hear, and also on social media, you hear everyone talking about EUV. But really, DOV currently is driving the main growth in sales for ASML. Doesn't mean that EOV is not growing. Definitely, it's still growing. But I think it's important to know. But also have a look at their service and field options. It's really becoming nice. And I will touch a bit on that next. Because as you can see here, the machines are just really growing quickly, 20% growth here, while EOV units, you could say, is only going from 26 to 31 to 42. Remember again, these are really expensive machines. And by the way, what's also really interesting for me, please tell me one company that only sells 309 units and earns 13.6 billion out of this. Just name me one company, because honestly, I couldn't think about it. Amazing, amazing for the individual unit cost. Wow. But I also wanted to get back to you about the service and field option sales. So let's call it the after sales, yeah, once the systems are installed and sold. Look at that. It went from 3.6 billion to almost 5 billion in a single year. And look also, therefore, I calculated this for you about the margin that this business line is operating under. So generally it was hovering around 40, low 30s, but now 53%. And, you know, this is what is so nice. And we just spoke about the refurbishing, the upgrades and such. This is really becoming a lucrative business. And I see it a little bit as selling an iPhone. That's just the start of the hardware, and then the whole app store on top of it. This is how I look at the service and field option sales. And what is nice about it, even if system sales would start to decline, for instance, because I don't know, incoming competitors, you have a big lock-in, because a company won't just replace 150 million just like that of such a machine. So expect the sales even to linger on longer into the future and grow longer into the future, even if in any case, I don't know, 20 years from now, system sales would start to decline. This is really giving this company, in my opinion, a really strong moat. But what is also good to mention here about the service and field options, and we can see that also because most of the hike here is actually contributed by the impact from supply chain issues. Because what happened, because of supply chain issues, it's harder to produce and keep up with the demand for those new EOV and DOV machines, that they actually start to sell more of their upgrades and refurbishments to their existing install base. So there you go. Even if there's an issue in the supply chain, you get the revenue on the other side by just upgrading the whole install base. I mean, amazing how this is currently performing on all angles. And this is for me also a typical business that you can consider a flywheel. I'm really deeply impressed by it. So having said that, I think their business model is amazing. And this is one of the first reasons why I could consider buying this company. But the second reason is also strong growth forecast. Because if we look at it, the trend is just there. And if you look at the sales forecast in the annual report, page 48, just look it up. I would really recommend once again to read the annual report. They expect an increase of around 20% compared to 2021 when it comes to this. So we're talking about going from 18 billion to 22 billion in sales at a margin of around 52 to 54%. Which is amazing. And you can also see already the first quarter expectations. So in a week or two, we can start looking into this, whether they really met their forecast here, but 3.3 billion to 3.5 billion and gross margin of around 49% in this case. So we will know this really soon, whether they're living up to expectations. If they won't hit it, I expect a short decline, which might actually be a buying opportunity for you. Long term, this is also what I took from the Investor Day presentation, and they took it again from Gartner forecast. I mean, you see it all over the place. They expect semi and the end markets to grow with 7% annually. And, when they say 7% annually here, it means more percentages to ASML because it's only one of the machine providers to the industry. And that then also translates into their own sales forecast. So they have a low end of selling 313 machines in 2025 and a high end of 452. I believe it will be probably more towards the high end actually than the low end based on all the industry trends that we see. Unless we would say a really global recession now, then we might be maybe more seeing it at the low end. But it also means a sales between 24 billion and 30 billion. Even the 24 billion sales compared to today is still a really good growth number. And we don't need to look far because actually we can just look at, the order book is maybe not the right word here, but the contract liabilities that they have coming up. So their obligation based already contracts that they signed to deliver machines, for instance, to their customers. You can see it has grown from 5.6 billion to 11.1 billion. And we know that one of the increases was really because Intel already buying or ordering some of the upcoming new systems of this EUV 0.55, this one that they can only deliver by 2025. So this for me also really bullish on why I own Intel, because Intel will get one of the newest equipments in the world to start producing and manufacturing for their customers. And I believe this is really something bullish for me. And what I actually like even more about it is that historically, ASML is now in a position to pay back Intel because Intel needs ASML now. And for me, this is kind of a nice love story, right? In 2008, Intel saved ASML with a 15% investment. And 1.5 decades later, ASML is paying back its duties by providing Intel as a first customer here. I really find it a nice story. So having said that, also here, in my opinion, ASML has really a strong growth forecast up till 2025 and even to 2030 and probably beyond. But there are some risks associated to the business because so far I've been so bullish, and investing comes with risks, and also businesses come with risk, even a monopolist. So what I would like to share with you are a few of the risks that I see. And for instance, we are talking here about a really complex scientific problem that they're trying to solve, and also with Moore's law and such. ASML says that they have really not reached the physical boundaries yet of what they can achieve. So I would again advise you to read up on it. It's all on ASML's website. But if there's another country like China, for instance, going to invest in this, who knows? Maybe they come with their own solutions, their own company that can start to compete. But I can tell you it comes with a lot of R&D investment. But who knows? It's really about getting the right talent in ASML. But also, competition is not, how you say it, doing nothing. They see this lucrative business and the high margins, because a 53% gross margin means a really lucrative business. I think Visa has, for instance, 80%. That's really high, but 53% is really a good business to be in. So competition is naturally there. I'm sometimes also thinking, like, wouldn't just someone just steal all the IP of such a machine and just copy all the patents, specifically in China or something like that? I can imagine that somehow the Chinese government already acquired such a EUV machine, has totally unscrewed it and tried to see every component what it does, that they can start copying it. And last but not least, the risk that I see is just governmental intervention. Governments don't like monopolists, so as long as ASML doesn't do like really aggressive pricing and really starting to act like a monopolist, maybe they are fine, but you never know. We don't know what happens in the next 10 years. We can see already the government is really investing heavily in the chip industry because they see it as something really strategically important from a, let's say, a global power point of view. So I don't know what this is meaning for a company like ASML in the upcoming future. So also here, take these risks into consideration, even if you're really bullish as myself when it comes to the business of ASML. But hey, a business doesn't necessarily make a good stock yet, right? So let's start to look into that as well. And for instance, let's start having a look at the dividend safety profile of ASML. So it should come as no surprise that, this company has a very safe dividend. With such a growth prospect ahead of you, why wouldn't it be safe? So last week I showed you T. Rowe Price. If you're interested in that, check the link in the description of the video below. It had a safety score of 90, but ASML gained a safety score of 94. This is really one of the safest businesses on the world when it comes to dividend payments. If we look at it, the company grew with an average EPS. I think that's the most reliable at the moment, 33%. Why EPS? Because in the free cash flow is the 5 billion upfront payment from Intel in there. So it increases the numbers a little bit unrealistically. So 33% 5-year average growth, which actually aligned with their dividend growth, right? Which is around 35%. But they have a healthy balance sheet, debt to equity 40%. It was mainly increased last year because of the buybacks that the company is doing, but they can pay it easily with 123 interest coverage, no problem at all. Also, the dividend is nicely covered with around 40% forward EPS payout. And if we look at the commitment to the dividend, 36% dividend growth over the last 5 years. And in the last recession, 2020, it has an increase. I'm not looking at 2007, 2008. It was not the same company back then, totally different. Hence, in my opinion, the dividend is very, very, very safe. So great business, great forecast, safe dividend. Let's have a look at the valuation. Because maybe this company is just too expensive, right? And that's also what people always tell me in the community. Hey, European DJI, have a look in ASML and just tell us how much overpriced it is. Well, let's get into that because I would like to share some more on that and show you also what the optimum buying price is. So from a dividend history point of view, we saw that already, right? But what I also wanted to point out here is like the buybacks. So last year they bought back around 2% of their share count, which came at a high cost, approximately 10 billion, but okay. I think it's important to know because it is one of their promises when we look at, for instance, shareholder return. Dividend yield is really, low end. It usually doesn't pass my screener of 2.75%. I will get back onto that in the next topic, which is currently there for 1%. Don't look really at the price to earnings multiples here. Usually it also doesn't meet my screener criteria, but there's a lot of growth behind it. So maybe the multiples are actually not so high if you look into the growth. Last but not least, I think what is really important here, just to call out from the metrics, is that their return on invested capital is around 36-37% on every dollar invested. This is 28% more than the weighted average cost of capital. So what you pay to, for instance, borrow, money from the bank. So they create, and this is what we call shareholder value creation, 28% shareholder value on an annually basis. This is really an amazing business, and I think Buffett would love it. So let's have a look then at the fair value calculation using a discounted cash flow model, which means like we discount for all the future cash flows that we are thinking that the company can generate towards what it would be worth today. That's really what we're doing it. So you just count for 10 years all the future cash flows using an annual growth rate and discount it with, for instance, the discount rate to what it is worth today. And what I can tell you here, I've been using a free cash flow number of 6 billion. Now, why 6 billion? Net income was 5.8 billion last year. You can see that the free cash flow was much higher, but this was because of this one-off payment from Intel. At the same time, there was also a little bit of adjustments in the net income number of why it was a bit lower, 5.8 billion. So I think that 6 billion is really a good free cash flow number to base the calculation on. Now, in my opinion, the first 5 years, the company should be able to grow 20% of this cash flow and then 12% thereafter. I really think that this is not a bad number. We have seen what the revenue has been growing. We have seen also what the earnings have been growing over the last 5 years, here 33%. So I really don't see this as an issue. Actually, I might even be on the conservative side there. But if I use a discount rate of 10% and therefore also for such a high-performing business, a terminal multiple of 20, I believe that the company would be worth 710 euros right now, which is, of course, a big difference compared to 570 euro right now. But we also need to know that this company was actually trading in the 700s not too long ago, just a few months ago. And you can see that here because the company was trading 731 euro just on November 2021. And it dropped all the way back to around 520 and then bounced briefly back up again. So not too bad, but if we look a little bit more optimistic, I'm not sure if they can still grow 30% per year on an annualized basis in the next 5 years. So, but 25% should be possible, right? And 15% thereafter. Then we are talking about a company which should be fairly valued at that time by 891 euro. In this case, we would be speaking of a highly undervalued comp right now. But imagine that the growth wouldn't be so quick, and 12% and 8%, and therefore also a lower terminal multiple of 15, which, by the way, is more than twice lower than what it is today. Then we're talking about 372 euro. Honestly, I have my doubts whether this is really possible. Even in a big recession, I still think they will be able to make up to 20%. Anyway, having said that, I think therefore if you mix this all together, my fair value at the moment is 670 euro for the company, which means that the shares, in my opinion, are currently 17% undervalued. And I think this comes as a big surprise for many of my followers, because they know when I see such multiples of almost 40 that I already don't even look into it. So guys, thank you for voting for ASML, because I would have never ever looked into ASML as I've done over the last 24 hours. I spent like 10 hours reading up on it. So, you know, I really became bullish on it, and now I understand also why a lot of the investment community is looking into this. But you know, then there's still this nagging question in my head, like, why pay a 1% dividend yield? Do I really want to wait 10 years for it to become 3 or 4%? I'm a dividend growth investor, not a growth investor. I need these dividends, I need the cash flow once I retire. So let's look into this as well. What's really the dividend growth potential, and what are we really talking about after 10 years of dividend growth? So, okay, what is important here, right? If we look at ASML's capital allocation policy, they're actually prioritizing buybacks, I think, even more than dividends. And this is something you need to take into consideration, because they've been really aggressive on buybacks, as you can see here. However, what we can see here is that the CFO is still really expecting to continue strong cash returns to shareholders. So from a dividend point of view, I think we will see relatively something similar as over the last 4 or 5 years. So if we then calculate this, right, and the company is currently yielding 1%, but imagine that this company will continue to grow over the next decade with 20%, we're talking about a 6% yield. I don't see this as unrealistic, actually. And if we take the 30% growth rate that we have seen in the chart porn and the first thing I showed you today, if they do this another decade, we're talking about after 9 years on a 10% yield on cost. So it is possible, it's really possible that after 10 years to have almost a 10% yielding stock. So I was surprised by this. I didn't really expect this. And this also means, like, you know, the company's undervalued. It has a big yield on cost potential. So I can tell you, I'm seriously considering maybe to buy 1 or 2 shares just to get used to ASML, because I'm very, very bullish at the moment, very optimistic. I know that this is the way how I am emotional. So I'm considering to buy 1 or 2 shares this week just to get a feeling for it. And if it hits ever into the 400, consider me to buy more, specifically when it reaches a 1.5% yield on cost, because then we're really talking already about 6-7 years afterwards to have a 10% yield with these growth numbers. So guys, this is it from my side. ASML, your wish was my command. I'm very thankful that you asked me, or kind of pushed me to look into it. If you have any questions, please follow me on the social media. And just get in touch with me. I really like the engagement, specifically on Facebook and Twitter, in the Dividend Talk group as well on Facebook. And yeah, if you want to see more of this, have a look at the video on the left, which is about T. Rowe Price Group that I analyzed last week. I think it's also a very safe dividend stock and maybe very interesting for you. And check the video on the right if you want to see another inspirational video from me. Guys, having said that, have a good weekend. Remember, I'm not a financial professional. I'm an amateur, just sharing my journey. Have a good weekend, everybody.